Welcome back everyone to the Moneycontrol Livestream. You are watching Markets with Santo and CJ. Well, I was hoping that we'll be able to sustain the gains that we have seen in the morning, but it seems like market doesn't want to go my way, Santo. It wants to go your way. As you predicted, we have come considerably off the day's high, and but the good thing is, the silver lining is that after the collapse that we saw in stock prices yesterday, at least we are going to close on the positive side, and that looks likely at this point of time.
Well, CJ, we still have half an hour of trading left. I don't want to spoil your mood, but well, it seemed pretty obvious, at least, that the market was kind of, not getting the true import of what the Fed chair had said yesterday. He had hiked interest rates, but they were almost celebrating as if, there was a interest rate cut of 50 basis points. So I don't think this really comes as a surprise. There is no conviction at higher levels, that much is evident.
Yeah, clearly. I mean, Nifty and Sensex both have come sharply off. We were up by almost 1.5% at one point of the day. Right now, we are barely up about 0.2 to 0.3% on the Nifty and Sensex. And profit booking is clearly very evident towards the end of the last hour of the session. We are seeing considerable profit booking, and this could be a result of what Santo suggests is a lack of conviction in the market. That said, the fear index, or India VIX as we call it, did fall substantially. It was down more than 7% right now in trade, and that basically suggests to me that there was a little bit of covering of short positions from the bears, which has helped the market stay in the green, at least for the time being. That said, despite the volatility that we have seen in the market, Santo, LIC is choo-chooing like a smooth train right now. The buying is totally consistent. Building on yesterday's gains, right now the issue was subscribed almost 85% at this point of time, and it looks like probably by the end of day today we would be edging closer to that fully subscribed mark for the IPO.
Well, CJ, I don't think it was ever in doubt that the LIC IPO would not go through. The only point of interest, I think, was how many times would it get oversubscribed.
Okay.
And right now it is, given the overall market conditions, it's a bit natural that you're not seeing too much of interest from foreign institutional investors. But that said, I think it would be a good opportunity for the domestic investors.
That, I mean, probably, but if you, I just want to point out one thing that I noticed very interesting in the LIC IPO is that, how many shares foreign investors have subscribed for in the issue? Take a guess.
Search me. No?
Take a guess. Wild guess. Come on. You can do this.
No. Tell me.
255.
That's it?
Yeah, 255 shares. We have towards the end of the second day, and so far FIs have only subscribed 255 shares.
That's really.
So I don't know what to make of it. Probably you would, with bigger brains, you would know what to make of it. But these are institutional investors,
No, I don't. I think we set too much store by way of what FIIs are doing. It's not that they write all the time, and sometimes when they don't subscribe to issues, probably you should take it as a good sign that there is less hype over the issue.
Okay, we will keep on debating on that. Let's quickly move on to some of the stock action. There's a lot on yours and my plate.
Yes, starting with Deepak Nitrite, the company came out with a decent set of fourth quarter earnings. Net profit and revenue were up quarter on quarter. But that was the point I was making, CJ, that even where companies are coming with good quarterly numbers, clearly the concerns is about the valuation. So wherever the valuations are high, I don't think the market is in a mood to kind of bite those stocks. In the case of Deepak Nitrite, so stock is trading almost 13 times its book value. Besides, there's also the impending QIP issue. The company is planning to raise about 2,000 crores. So these two factors put together could perhaps explain why the stock slipped 4%, even though the numbers were quite decent.
Well, Santo, chemical stocks have made a lot of money for retail investors, and I agree there are some near-term headwinds coming in terms of margin pressure, in terms of higher input costs for Deepak Nitrite, but the stock has been a multi-bagger over the past 3 to 5 years, and the QIP, instead of seeing it as a risk, I will actually see it as an opportunity. The fact that the company is willing to raise 2,000 crores in a market like that, and I'm pretty sure that it will also be able to do that, it just goes to show that it's willing to invest as much as possible in its future. And you talk to any smart investor on the street, people look at the specialty chemical names in this market as a 10 to 20 year story at this point of time. So I will not be surprised if a lot of retail investors probably would be buying the dip alongside some of the institutional names as well.
10 to 20 years is a long time, CJ, and I'm surprised I'm hearing it.
Look at what IT has done. Look at what IT has done. Anyway, moving on. A stock on my radar was SBI, and I know you would probably be frowning that why am I looking at SBI? But the stock was higher in trade today, but I have a little contrarian view on SBI at this point of time. It seems like the rate hike that, excuse me, that the RBI has done yesterday, that could possibly temper some of the optimism that SBI has seen from both retail as well as institutional investors. It is given that its bond portfolio is going to take losses. It is going to see mark-to-market losses in its treasury side of income because of the sharp increase that we have seen in bond yields this quarter, and probably will see going ahead. Some are already expecting yields to rise as much as 8% over the next 6 to 12 months. So that is one point of concern. The other is that SBI's loans, the loans that SBI gives out, especially the floating rate loans, they generally are marked to the MCLR, which is another benchmark that is used, instead of the external benchmarking lending rate, which a lot of private sector lenders use. Because of this, this difference in the private sector and the public sector, SBI would likely not see as much benefit from the rate hike or the higher deposit rates or higher loan rates as probably some of its private sector peers. So that probably could temper some of the enthusiasm that investors have towards margins of SBI going ahead. And lastly, the CRR hike that was done yesterday of 50 basis points could affect SBI a little bit more than other peers of its size, largely because it holds a larger amount of liquidity at this point of time. And if you look at the ICICI Securities report on this, they expect SBI and YES to be the worst impacted out of the CRR hike compared to a lot of the other lenders.
Well, fair points, all of them. But CJ, as I said, once again, the same argument that, in an uncertain market, people look for valuation comfort, and, SBI by virtue of its size and also the valuation, just about one time book, clearly offers those support. So I think even if there is a dip, I don't see the stock underperforming too much. Well, IRCTC is the next stock on a watch list. Now, huge buildup of short positions there. Already
surprising.
Not really surprising, because much of the positive news has already been factored in. The stock was quite hot about 6 months back, when it was when people were talking about as comparing it on par with other big tech stocks. But now clearly that has faded quite a bit. And if you look at the increase in short position and also the build up of short position in the SLB segment, there are about 21 lakh shares outstanding there also. And the futures, they're quoting at a significant discount to spot.
First off, what is SLB, my friend?
That is stock lending and borrowing. So
okay.
You borrow shares there. Whoever is willing, whoever got excess shares, he can borrow it to someone, he can lend it to someone. Okay. That person in turn will sell it in the market, and when the prices fall, he will buy back the shares from the market and hand it back.
So basically, those who want to short a stock will
yes,
use
SLB is the mechanism, is the window for them. Also, the huge gap in prices between futures and the spot price. The futures are trading at a huge discount to spot at this point in time, and usually in the past we have seen that whenever that happens, instead of the futures catching up with the spot, I think it often moves in the reverse direction.
That might be true. I think the reason why we are seeing that sort of a discount in the futures and the spot price is likely the fear of an impending OFS on the counter. We had reports suggesting 2 months ago that government is likely to sell a bit of its stake in IRCTC, not only to raise some of the divestment fund, but also to improve the public free float in the stock. So that could be the reason why you're seeing the sort of shorting that you're seeing in IRCTC. Yes, the stock has fallen considerably from its record highs that were hit in October 2021, largely because IRCTC was being valued as an internet platform company, and we know what has happened to all internet and tech names because of the rising bond yields. Now, coming back to fundamentals, I feel that the fundamentals of the stock still remain quite buoyant. If you look at the surge in traveling that we are seeing, if you look at the commentary that is coming in from the hotel industry, bookings are at record high. Almost they are running out of capacity to book rooms right at this point of time, and IRCTC being one of the most preferred means of transportation for a large swath of this country, it will automatically benefit from this, binge of traveling in the coming 6 to 7 months. So I feel while technical factors may be weighing on the stock at this point of time, if you take a longer term view, maybe 6 to 12 months, you may end up benefiting in the long run.
Well, it's that 100 times price to earning which the market is giving right now. We'll need to see whether it will still give it another 6 to 12 months. We have often seen cases where the earnings do move up significantly, but the dizzy valuations which some of these stocks enjoy at the peak of a bull run, they somehow never get there once again. So while I do take the point that this is a good stock, all it will benefit hugely from traveling and all that, but will you see a big upside? That remains to be seen.
Well, I'll tell you about another good stock, Santo. That's Monte Carlo. The stock has given a positive breakout in the session today. It's moved beyond its 30-day and 50-day moving average. It was higher by almost more than 5% at one point of time. Now, what is the story here? Investors are largely betting on a very strong March quarter and June quarter because of the reopening of the economy that is leading to kids going back to schools, people going back to offices, people going out traveling. So therefore, there's a lot of demand for new clothes and apparel, branded clothes. Now, the March quarter update of the company suggested that it had record sales during the quarter, which only goes to show that the sort of earnings momentum it is already witnessing at this point of time. The Q4 earnings have not come yet, so they are yet to come. But it is very likely that the market is already anticipating a very strong Q4 number and even possibly a Q1 and Q2 numbers as well.
JSPL, the next stock on our watch list, the stock was up 2%, managed to hold on to its gain through the day. According to MC Pro, the company will turn net debt free by the end of this fiscal. Besides, also, it will be getting the iron ore, captive iron ore over the next 18 months from its recently auctioned, the mines that it had bought during the auction. Plus, at the same time, its cost of coking coal will also remain low because of its captive mines. So clearly, on the raw material side, which is the input prices which are hurting steel companies, that will not be so much of a problem for Jindal Steel and Power.
True. All of your arguments are very valid, but if you take a step back, if you look at some of the steel companies right now, the main story still seems to be pricing, right? Volume has not yet picked up to levels where volume starts dominating investor psyche and pricing takes a back seat. And on the pricing front, we have seen commentary coming out of some of the bigger peers of Jindal Steel who have come out with their earnings, suggesting that we have probably reached the peak of steel price hikes that we could have. At this current point of time, if you had Tata Steel's MD TV Narendran coming out and telling CNBC that they already are seeing peak prices for steel products already, and with volume now being constrained due to some of the industry backlash that they are facing. If you look at construction companies, if you look at automobile companies, now customers are starting to push back a little bit, maybe cut down on volumes or look for alternative sources. So therefore, maybe the industry will not have the same sort of pricing power and the sort of margin growth that they had seen over the past 1.5 years. And now the story should move towards volumes, and it will be very interesting to see that in an environment where government borrowing costs are likely to rise, whether they will be able, whether the government capex push will come as much as it was expected earlier. Also, with the RBI raising interest rates, will private capex revive as soon as market was expecting earlier? So those will be two very big concerns that market will be looking out for on Jindal Steel. Moving on from Jindal Steel, two stocks where there are surging concerns are Godrej Properties and DLF. Now both are real estate plays, and we know what happens when interest rates rise for real estate companies, right? Realty demand so far was spectacular. I mean, the affordability of housing in the country had dropped to multi-year lows because of the sort of accommodation that the central bank had given. Now that accommodation is being withdrawn with the 40 basis point repo rate hike yesterday, as well as the rise in CRR, as well as other liquidity measures that the RBI has taken, there is concern emerging whether the demand up move that had started possibly 12 to 18 months ago, how long will that sustain, right, in this market? Remember, a lot of the home loans are generally floating loans, and the rate hike will largely affect the home loan segment the most, apart from small business loans as well. So there is a possibility that if real estate companies were pricing in huge surge in demand over the next 2 to 3 years, that could get a little tempered because of the aggressiveness the RBI is willing to show right now to tackle inflation. And I think that was the bigger overhang on the stock at this point of time. Besides demand, if you also look at the supply side for real estate companies, construction costs are rising at this point of time. We already mentioned where steel prices are, we already mentioned where cement prices are. Now with those sort of costs rising, it is becoming difficult for construction companies to undertake projects because their investment returns are declining. And that could be a double whammy for real estate companies, is what my opinion is.
That's a pretty long pitch. Okay, CJ.
You.
Now, when it comes to real estate, true, interest rates do have a bearing. It does influence, but to a limited extent. I would say the bigger factor there is that an individual's outlook on earnings and similarly a business outlook on earnings. Now, in the case of individuals, if you see across all sector, there's a severe talent crunch. Wage inflation is the biggest problem of almost every company, every industry right now. So the outlook on earnings, on income, that is pretty strong at this point in time. So while I do take the point that at some point, higher interest rates will start to tamp down on demand, but at this point, I would say that it's not going to be that big a factor, and probably one should look at these stocks on declines.
Okay.
IndiaMart Intermesh, the last stock on my watch list.
Wow, an internet platform stock. 2 internet platform stocks on your portfolio.
And for a bearish reason. So,
okay. As usual.
Yeah. So this company had announced a buyback of shares last week, and that certainly did not go down well with the market.
And who told you about that?
Well, the great CJ himself. And what has happened is that there's been a rapid build-up of short positions in the stocks. Purely from a technical point, probably the stock could see further pressure. There's been almost a threefold rise in open interest in IndiaMart Intermesh futures segment, and the futures are also quoting at a sizable discount to the spot price. This indicates that there could be further pressure on the stock.
I believe this has happened for the second time with IndiaMart. You remember in March as well, there was an instance where the stock was, the futures price were down by what, 11% at 11% discount to the spot prices.
Recently, in fact, for much of April, the discount of the futures and the spot was about 50 to 60 rupees, but it dramatically changed after the announcement of buyback. That's where I think the bears are really piling onto the stock.
Well, Santo, on this stock, even I can't argue with you because things are not really looking very pretty for IndiaMart.
Yeah.
Valuations are being compressed. Of course, there is also doubt over its fundamental side of the business because of the sort of competition it is seeing from Just Dial. So a lot of things are not going, plus the trust or the confidence level of the market at this point of time on the company is a little low, given the utilization, how the utilization of QIP funds have happened, given this sudden announcement of a buyback when the company should be looking at growth opportunities. So yeah, that is one stock I will agree that probably the bearishness is very much merited.
Well, and CJ, in case you missed it, interest rates are rising. I think that's something.
The RBI one, right?
Yes. In fact, the market seemed to have completely overlooked this fact that yesterday RBI had hiked repo rate by 40 basis points, and today banks are following suit. Now, most of the loans are now linked to the repo rate, which means that as soon as the repo rate goes up, the transmission is quite immediate.
Absolutely.
Earlier in the past, transmission used to be slow, but it's so slow only when rates are falling, but this time
banks will not let go of an opportunity to charge
otherwise
more
banks are
interest,
very quick to raise rates so that's happening, and that's not good news for consumer sentiment very clearly. Now you'll see auto loans, home loans all getting expensive. It also means that less disposable income in the hands of consumers, and I think you'll see that playing out in the economy.
Tell me about it. Tell me about it. I mean, the amount of inflation that we are seeing, I mean, at this point of time, the Maggi that used to fill my tummy, the 10 rupee Maggi that used to fill my tummy once upon a time is not working anymore. So I can't have escape foods anymore or snacks anymore because it's become so pinching on the wallet at this point of time.
And there's a risk for equity markets as well,
Equity market?
Yes, that's because when bank FDs start to rise, and now we have already seen that over the last 6 months or the markets has not really gone anywhere.
Yeah.
Many stocks are under pressure. So once returns from equity market starts to come down, and at the same time you have bank deposit rates rising, investors are tempted to take out a small portion from of their equity investment and park it in bank deposits, where they can enjoy, they can get returns even if it's slightly lesser, but with less heartache. So that shift will happen, and that in turn could put further pressure on equity prices in the days to come.
I think these will be the very risk averse sort of investors, because if you look at the longer term trajectory of equity returns, they will any day outperform FD rates, right?
You're speaking my language. Yes, longer term I know that, but you know, there's no harm in being opportunistic once in a while.
I wonder if there is that much of an opportunity at this juncture. Maybe if FD rates rise even more, 200-300 basis points more, then possibly. But at this point of time, when EPS growth of Nifty 50 companies is expected to be about 19% in FY23, that means that you generally can expect that the market will rise by 10 to 15% in FY23 if those expectations
it's not
come
so
out
much about also, you know, the earnings growth. I think it's also whether market will give that kind of valuations. Already you've seen that market is reluctant to give higher valuations, and the fourth quarter numbers so far, whatever we have seen, you know, barring a handful, we're not seeing any spectacular earnings.
We have not seen spectacular earnings, but we have also not seen down out howlers.
Yeah,
like
because
Indian
those will start coming out in this quarter, you know, once the impact of inflation starts eating into the bottom line.
Yeah, that said, tomorrow's trade, I mean, there are not big events like there were yesterday with the RBI.
One never knows.
But of course, RIL is going to come out with its earnings tomorrow after market hours, and Tata Power as well is going to come out with its Q4 numbers tomorrow. Apart from that, in the US, the non-farm payroll data is going to come out, and it's going to be very important because the job market report could determine how fast the Fed wants to move. If the US job market remains as hot as it has remained over the past 1.5 years, then it could force the Fed to bring back the dreaded 75 basis point rate hike in the coming meeting. So those would be the two broader things that I'll be watching out for tomorrow's session.
I read an interesting line, you know, in one of the columns, and I think that was in the Financial Times, that, you know, the Fed denied something that it had never articulated in the first place, which is a 75 basis point hike.
Absolutely. I think we should just quickly take a check on the market before we leave you. At this point of time, it doesn't look very, good for my expectation that the market will close in the green, because the Nifty is largely flat. Even the Sensex is up only by 0.1%. Nifty Bank has turned into the red, down by about 0.1%. And Nifty Mid-Cap is slightly outperforming, up by 0.2% at this point of time.
Well, that's what the 16,800 support level is something that most traders are closely watching, and if the Nifty is unable to sustain above that, it could mean further weakness. But CJ, here's the good news. Probably if the market cracks, be ready with a list of, you know, the stocks that you always wanted to buy.
I'm always ready with a list of stocks. Anyway, talking of stocks, some of the big laggards right now on the Nifty are IndusInd Bank down about 4.5%, Tata Consumer Products down about 3%, Britannia 3%, Sun Pharma down about 3%, RIL, the index heavyweight, is down about 2% ahead of its earnings tomorrow. So very interesting moves in the market towards the last half an hour of the session.
Yes, so I hope you enjoyed watching this episode of Markets with Santo and CJ.
Yeah, and we'll let you get back to your trading terminals. But before that, please do not forget to post your feedback on the comment section below and follow us on the social media links at the bottom of your screen. For rest of the updates, stay tuned to moneycontrol.com and to the Moneycontrol app. We'll catch you tomorrow live at 9 a.m.
Goodbye till then.